Welcome to the M&A Unplugged podcast. Our mission is to help you be better prepared for your business acquisition or sale. Being prepared will ensure you maximize returns and minimize risks. This is M&A Unplugged with your host, Domenic Rinaldi.
Welcome back to M&A Unplugged. I'm your host, Domenic Rinaldi. Understanding the tax ramifications of a business sale or acquisition is a critical component of the ultimate return on investment. Today, I'm being joined by Ed Castellani, a partner in the law firm of Frazier Trepealcock. In addition to practicing business law for over 30 years with a specialty in mergers and acquisitions, Ed is also a certified public accountant. This is the perfect 1-2 punch for any client retaining an attorney that has both a law degree and an accounting and a CPA degree. In this episode, Ed and I discuss the tax ramifications of an asset versus a stock deal, things to consider when allocating the purchase price in a deal, what to include in a letter of intent to make sure that the tax issues are properly identified, the issues related to a C Corp transaction, and many other tax-related issues. This episode is stocked with some great advice. Before we get into today's episode, if you want to avoid the common deal pitfalls and the risk of losing substantial dollars, you need to know how ready you really are to buy a business. Because I believe that proper preparation is so critical to your deal success, we have published a catalog of free resources to help you be better prepared. You can access these resources on our website at k2advisor.com/resources. K, the number 2, advisor.com/resources. Being prepared is critical to ensuring that you maximize returns and minimize risks. As always, thank you for being here and hope you enjoyed today's show. Ed, welcome to M&A Unplugged. So nice to have you here with us today.
Great. Happy to be here, Dom. Thanks for having me.
Yeah, I really appreciate your time. You have such a unique skill set and experience, having practiced law for over 30 years, but you're also a certified public accountant. What a benefit that is to your clients. And I know you focus a lot on M&A transactions. They must really appreciate the fact that you can look at a deal from both of those lenses.
Right. When you're structuring a deal, one of the most important things of the deal are the tax consequences. The buyer has certain interests and the seller has certain interests, which are sometimes different. But I can help them with that. I know what the tax consequences are. I know how to plan for tax consequences, and that sometimes affects how the transaction is structured and how the documents are then prepared.
Yeah, without a doubt. You've been doing this a long time. I've been doing this a long time. My experience has been that people just don't spend enough time thinking about the tax consequences and how to optimize them, whether you're a buyer or a seller. I'm assuming your experience is the same.
Yeah, and sometimes they don't start thinking about it until we get into the document, and we've got drafts going back and forth, and clients start understanding what this does to them tax-wise and what it doesn't do. So the best thing for a tax practitioner to do is to have that conversation up front. What kind of transaction are we going to have? Are we going to have an asset sale? Are we going to have a stock sale? Those type of questions should be some of the first fundamental decisions that are made before you start passing documents around.
Yeah, without a doubt. And I mean, I think best practice is you really should be contemplating, at least broadly, these things in the letter of intent. You might not be getting down to the actual details, but at least assimilating, what you're looking for from a tax structure in the LOI, so that you don't wind up with a complete renegotiation at the closing table or in the definitive agreements.
Yeah, that's exactly right. And that's one of the purposes of the letter of intent. You know, the letter of intent is a preliminary agreement that's usually a non-binding agreement, so either side could walk away from it. But one of the purposes of it is to get the main points of the deal out on the table. And those main points, you know, include whether it's going to be an asset transaction or a stock transaction, you know, what the price is going to be, how's the price going to be paid. There's usually provision that everything is going to be kept confidential. And those fundamental questions are what's addressed in a letter of intent. So that's a good point. That they have to be addressed there, actually.
Yeah.
Yeah.
Well, so maybe we start at the beginning. I mean, the obvious first place, I think, is, you know, the parties. And I say the parties, both the buyer and the seller, because, you know, the tax consequences are there for both parties, is whether or not it's an asset sale or a sale of the stock. And maybe you can help us think through, you know, what are the ramifications for people, and when should they be thinking about, you know, one or the other?
Right. Well, let's take a seller's perspective first. What the seller wants in a transaction is long-term capital gain. That's the best tax consequence they can get. And the best way for them to do that is to do a stock sale. When they have a stock sale, whatever sales proceeds they get in excess of their basis in the stock is taxed to them as long-term capital gain. So that's great for the seller. Sellers love selling stock. Buyers don't always like buying stock, you know, for a couple of important reasons. Buyers don't like doing that. Buyers would prefer to buy assets from the corporation. So then we've got a whole different set of tax consequences for the seller, depending on whether they're a C Corp or an S Corp or an LLC, and whether they're going to have long-term capital gain or ordinary income. That's where things really get interesting and planning becomes important.
Yeah. So, you know, we often say to our clients, you know, what from this perspective, what's good for you from a tax perspective is maybe not necessarily good for the other party. And in the scenario you just described, sellers, when they sell the stock, are getting long-term capital gains, which is currently at 20% plus the 3.8% surcharge. But the buyers then have to put that on their books and amortize it. And that's a big tax hit when you think about the fact that they can't immediately start depreciating those assets over a 5-year schedule. And it could get more complicated than that. Obviously, I'm being very simplistic here, but there's a big difference for both of the parties. How do you bridge the gap there for the parties?
Well, it depends on whether you're representing the buyer or the seller. But when I'm representing a seller, I persuade him to try to get the buyer to buy stock. If I'm representing a buyer, I tell the buyer, you don't want to buy stock, you want to buy assets. And then it's just a question of what those two parties can negotiate and who's the more motivated person. Is the seller more motivated to sell, or is the buyer more motivated to buy? Then they come together and they try to compromise and work out, what they can work out.
Yeah. It always comes down to motivation, right? Who's going to play?
Yeah.
And who's more
got
motivated?
the most leverage.
If you're on the buyer side, though, what things might, how might you coach the buyer through that? If the seller is demanding a stock transaction, knowing that's not the optimal tax outcome for them, what are some strategies that you may talk a buyer through in that case?
Yeah, well, if a buyer has to buy stock, they're buying an asset that's non-depreciable, non-deductible. So that really raises the price of the acquisition because they're buying it with after-tax dollars. Okay. So we tell the buyer that, this is going to cost you more. So you may want to work on that purchase price. You may want to try to bring that purchase price down because you're buying a non-depreciable asset. It's going to cost you a few more dollars. There's other couple techniques you can do. You can use a non-compete where the seller agrees not to compete and the buyer pays for a not compete. The buyer can write that off over 15 years.
Yeah.
The buyer could also buy personal goodwill of the seller. You can write that off over 15 years. So those are a couple things we look at in that situation. Yeah.
So there are some ways to potentially bridge the gap, but I think your point is that, they're buying this with after-tax dollars, and there may need to be some accommodation in the purchase price if the seller is adamant on selling the stock.
Right, that's exactly right. Yeah, and that's common. I mean, that is usually where the conversation goes.
Yeah, yeah. So let's spend a little bit of time on the letter of intent. From a tax perspective, there are some things that should be contemplated up front, right? So one, the parties and their advisors are clear, and two, you don't wind up with a renegotiation, a complete renegotiation somewhere down the road. And I'm thinking of things like, allocations, and you already talked about the potential for non-compete. So could you talk us through the letter of intent and what the parties really should be contemplating there as it relates to, the tax outcome?
Yeah. There's really two kinds of letter of intent. Briefly, there's a non-binding letter in which either party can walk away at any time, or there's a binding letter of intent, in which case the buyers are stuck with the terms in the letter of intent, which are later incorporated into a purchase agreement. But anyway, the important provisions like the tax consequences and whether it's an asset sale or a stock sale, and maybe even how the purchase price is going to be allocated to the assets, those should be addressed in the letter of intent, whether it's binding or non-binding, because that establishes the tax consequences. So those are the types of things that should be included in the letter of intent. And that's really the first step that the parties go through to flush out some of these important issues.
Hey, can we dive a little bit into allocation for, people who are listening who are, haven't gone through this before? Can you, give some examples of allocations and what the impacts are there so people are clear about that?
Yeah. Well, when a buyer buys assets from a seller, the purchase price has to be allocated to the various assets that the buyer is buying. And usually that's done by an appraisal. The seller or both parties will pay for an appraisal that will value the assets. And that appraised amount is usually the price that's used for the assets. To the extent that the assets are equipment, the buyer can write those off immediately, or the buyer can write those off over 5 years. If there's goodwill involved, if there's goodwill above the value of the assets, that's something the buyer writes off over 15 years, and it's something that the seller has long-term capital gain on. So the allocation of the various assets in the agreement is important because that's really what determines the tax consequences.
Yeah, yeah, and those, in the case of assets, equipment, as you had mentioned, or furnitures, fixtures, and equipment, that's an ordinary income hit versus goodwill, which is long-term capital gains. What are the buckets of allocation? So you've got assets, you've got goodwill, you also have non-competes, right? Potentially being,
right. You may have intellectual property.
Right.
You may have receivables. Sometimes a buyer will buy receivables, but the primary assets are the furniture, fixtures, and equipment.
Yeah, the hard assets.
Intangible personal property like copyrights and trademarks, and then any purchase price above those goes to goodwill.
Right.
Yeah,
right.
A bit of a simplified version, but those are the main.
Right. And there are, an inventory could be a category as well, but as we know, a non-taxable category, as long as the inventory is being transferred at cost, right?
You're right. Inventory is another important asset. And you're right, that's usually sold at cost, no tax consequences to the seller.
Yeah.
Right.
But, nonetheless, as we're talking through this, lots of categories, lots of things to be considered, and they should be considered up front. And even if you can't agree to the total values, at least identifying the buckets and knowing what you need to address, as you said, as you get an appraisal, I think is critically important, so that the parties and their advisors have the landscape, right?
Right. And it's also important if there's real estate involved. Usually always there's an appraisal on real estate. So that usually takes care of the real estate. But the thing that the seller should do, or a buyer, is talk to their CPA too. The CPA has to be involved at this point on this asset allocation, because the CPA will really know what the basis in the assets are, What's the depreciation recapture, all those tax issues. The CPA will know about that, so they've got to be included.
Yeah, absolutely. Have your team, as we always say, have your team in place very early and talk to them well in advance of contemplating these transactions, right?
Yeah, exactly right.
So we oftentimes, Ed, hear from sellers and the question comes up, how can I defer, reduce, forego tax liabilities in a transaction? What are the strategies? What can I do? And so I'd like to dive into that a little bit with you. So, you've got a seller. What are the things that sellers can do to defer or forego or reduce? And we've talked about one of those things as far as a stock sale goes. But what other things can sellers contemplate in order to minimize their tax burden?
Yeah, that is a good question. Well, if a seller is getting a cash deal, really the only thing they can do is be careful on how they allocate the purchase price, try to allocate it to their basis in their assets, and anything above their assets, allocate that to Goodwill. And that's the best thing a seller can do. But when you're getting cash, there's not a whole lot of tax planning that goes on after that. I mean, cash is taxable. Not a lot we can do about that if the seller is an LLC or if the seller is an S Corp. That's the case because it passes right through on the seller's individual tax return. Right. If the seller's a C Corp, then we got a whole different situation with there's a lot of tax planning that has to be done.
All right, so let's hold off that C Corp discussion for just a minute because I want to come back to that. I think it's an important one.
Right.
So, okay, you've got a scenario where they receive all cash. It's it's going to pass through. You've got limited opportunities. What about if can they structure the deal in a way so it defers some compensation, but they're still protected and it reduces their potential tax liability?
Yes, they can do some things like get a consulting agreement with the buyer or get an employment agreement or get a non-compete agreement. Non-compete agreement is ordinary income. They try to stay away from that if we can. And that can defer some of the tax, put it off to later years. It may or may not be a benefit, but it's an option. Yeah. There's also an installment sale. Instead of getting cash up front, you get the payment over 5 years or 7 years or 10 years. So that defers the tax, which may or may not be a benefit depending on what tax rates are going to be like in the next 5 or 10 years.
Right.
And then you've also got the risk of non-payment, the default by the buyer. Right. That's something you don't want to have to deal with if you can avoid it. Okay. So yes, you can defer some tax to later years, which sometimes is a benefit, sometimes isn't, depending on what rates are going to be in later years.
Yeah. So I think you bring up a good point. I mean, if you do defer, you're then expecting installment payments, which are at risk. Is there a way, and I don't even know if legally this is possible, but can those monies go into an escrow account? And it's released over some period of time, so the monies are there, and not have it be taxable day one to the owner, or is there still a risk that money, because it's been put into an escrow by a buyer, is still going to be taxable? Yeah,
there is a risk that it will still be taxable if it's guaranteed to go. If it's set aside and it's guaranteed to go to the seller, that there's no way that it can't go to the seller. It's probably going to be what we call constructive receipt and taxable at that time. So that may not do it. That would probably still be taxable.
Yeah, got it. Okay. So, and let's go back to the C Corp situation. Yeah. So, you've got a C Corp, as you referenced. There may be some ways to defer tax. Can we dive into that a bit?
Yeah, well, when a seller has a C Corp, that's not the ideal entity to be selling a business. So, and the reason for that is a C Corp is a taxable entity. It's not a pass-through entity to the shareholders. So when the C Corp makes a sale, those sales proceeds are taxable in the C Corp. So that money will be taxed twice, once in the C Corp and once to the shareholder when it's liquidated. So we want to try to eliminate the double tax. Yep. And some ways we do that is by paying bonuses out to the owner. If the C Corp has a pile of cash from the sale, they can pay bonuses for compensation or past years under compensation. That's possible to avoid an unreasonable compensation issue. As we said before, we can get payments in the form of a non-compete to the seller's shareholders, so that money doesn't go into the corp. Consulting agreement, employment agreement. There's also a concept that's become popular lately called personal goodwill. Personal goodwill is a technique to use when the seller is a C Corp. And in that case, the shareholder sells their personal goodwill if they can document that there is personal goodwill of the seller, sells their personal goodwill to the buyer. That money goes directly to the shareholder for the shareholder's personal goodwill, and that's taxed as long-term capital gain to the seller. So a combination of those techniques, should be considered.
Yeah. So let me dive into the personal goodwill issue for a second. So in this instance, when somebody sells their business, it's a C Corp, rather than the monies being received into the C Corp and taxed in the C Corp, there's a separate personal goodwill agreement with the owner, and those proceeds are coming directly to the owner in that case. Is that correct?
Right. Correct.
Yeah. So you're bypassing that tax in the corporation, comes directly to the owner. And because it's goodwill, by the mere nature, it's getting long-term capital gains treatment, right? Versus
long-term capital gain to the seller, and the buyer would amortize that over 15 years.
Yeah, got it.
So it's a pretty good technique, but you got to be able to justify that there is seller personal goodwill in that situation.
Yeah. What's the bar there, Ed, in your experience? What's the bar in order for, owner to reasonably state that they've got personal goodwill in the business?
Well, it depends on the facts, but it's really a question of whether the seller's personal name, whether the seller has personal contacts with customers, and customers are buying products from that corporation because of the personal goodwill, like an auto dealership. Auto dealership has the name of the individual on the name. Right. A professional, a PC like a dentist or a doctor's office. Again, those have a lot of personal goodwill. So it really depends on how much the individual's personal influence on the buyer, whether they buy products from them or not.
Yeah. Understood. Okay. And again, this is clearly an area where you need and want a professional to analyze this and give you their best advice. Last thing you want is an audit from the IRS, and you couldn't pass the litmus test, right? And not have a professional ready to back you up.
Yeah, correct. Personal goodwill is not authorized by the Internal Revenue Code, but it's really a contract matter between the buyer and the seller, like anything else.
But there is case law around it, though, right, Ed? Am I not mistaken? There is case law around personal goodwill, correct?
There's starting to be now. Yes, okay. There's a couple cases on it.
Yeah, and in the favor of personal goodwill, where the courts recognized it and it was approved, correct?
And it's heavily determined by the facts of each particular case.
Yeah.
But yes.
Yeah. Got it. Okay. Good. Anything else about C Corps before I want to move on to current events and what the current landscape of taxation and what might be coming?
One quick thing about C Corp is a C Corp can turn into an S Corp by electing S status, but it's got to wait 5 years before it can get the benefit of an S Corp. So you can't elect S Corp status a month before the sale and say, I'm an S Corp, everything passes through to the shareholder. You only get that 5 years after you make the sale. So you've got to plan that in advance if you're contemplating a sale and you're a C Corp.
And Ed, in that 5 years, is it an all or nothing? So you convert from a C Corp to an S Corp, so you don't have the issue of double taxation, and you have to wait the full 5 years, or is there let's say you sell 2.5 years into your conversion, are half the proceeds treated as a C Corp and half as an S Corp, or it's an all or nothing? That 5 years?
It's an all or nothing. It's like falling off a cliff. It's either 0 or 100%.
Got it. Okay. Fair enough. And it used to be 10, right? I mean, it came down. At one point in time, it was 10 years, right?
Years ago it was, right.
Right. So now it's 5. Okay. So Ed, let's talk about the current landscape. We've been talking to owners a lot about, one, the market in general. The M&A market has been incredibly hot. Tons of buyers, lots of money chasing deals. So it's a good time to be a seller. On top of that, long-term capital gains still happen to be 20%. but there's some looming, talk of tax increases, and we don't know what that means, but potentially. But what is your perspective on all of that?
Well, Biden has always said he's going to raise taxes. He said that before he was elected. And just this week now, some rumblings have been coming out of the White House about what they're looking at. And some of those things include changing the corporate rate from 21% to 28%. They want to increase the capital gain rate, and they want to increase the income tax rate on folks with incomes over $400,000. They also want to increase and expand the estate tax. So just about every tax we have, they're talking about raising it.
And the capital gains tax, which is of particular concern to anybody looking to sell, my understanding is they've been talking about going from 20% to somewhere in the neighborhood of 39 to 40%.
Yeah,
correct?
I've heard 40%. And as we all know, that we don't know what's going to happen until the bill is actually passed and signed, but they're talking about 40% long-term capital gain rate.
So, and Ed, we've been thinking that maybe this was something that was going to happen in 2022. Are you starting to think that maybe this is gaining steam and could get in front of Congress this year for passage this year?
Yes, they're now talking about putting these tax increases in this $4 billion so-called infrastructure bill that they're talking about right now. They're including it in that bill, which might come up and then start being talked about that in the next 2 or 3 months.
Oh my goodness. Okay.
So it could happen this fall.
Wow. And of course that would probably most likely be retro to January of this year.
Well, that's a good question. Probably be prospective from the date of the law forward.
Oh, you think so? Okay.
Probably.
Okay.
Yeah.
All right.
We don't know.
Well, we've certainly been on the bandwagon, talking to owners, and our comment has been, look, if your window's in the next 2 to 3 years, you might seriously want to think about pulling the trigger right now, for the combination of things that I talked about. One, lots of buyers, lots of money, so multiples are still very high. And two, you've got these looming tax increases that could really take a bite out of your proceeds.
Yeah, that's absolutely right. And I have clients that have done deals now because of that coming tax increase. Yes.
Yeah.
Mm-hmm.
What about buyers? I mean, we're talking about sellers here and get out while the getting's good, but what should buyers be thinking about in regards to this? I mean, they're probably sitting there thinking, wow, I'm walking into a hornet's nest. My taxes are going to go up immediately. So what's the wisdom around, what buyers should be thinking?
Yeah, it's more of really a seller issue. Seller's one who's going to have the gain, is going to have to pay the tax. Not so much a buyer issue, other than once they buy this business, the tax rate's going to increase, so they're going to be paying more income tax. That's going to reduce their cash flow. Yeah, that may mean the business price has to come down.
Yeah, and I have not seen that creep into any negotiations yet. Have you?
No, not from a buyer's perspective, but it's probably because we don't know what that new tax rate's going to be.
Yeah, right. And we don't know what the date of it's going to be and whether it's going to be retro or prospective or.
Correct.
Yeah. Ed, this is great information. As we start to wrap up here, what advice would you have for folks in the M&A Unplugged community, buyers or sellers, around, deals, whether it's tax or not? What advice would you have?
Well, I think you've mentioned some of those. It's a good time to buy. There's a lot of money around. Money is cheap right now. The tax rates are going to go up. So now is a good time to act. Yeah,
no doubt. Ed, if folks want to get in touch with you, how could they best reach you?
They can reach me at Fraser Trebilcock. My phone number is 517-377-0845 or ecast@fraserlawfirm.com.
That's great. Mm-hmm. Ed, really appreciate you being here and visiting with us. Pleasure to have you on the show.
All right. Good. I enjoyed it. Thanks, Dom.
Thank you. Appreciate it.
All right.
I hope you enjoyed this episode. All of today's information will be available in the show notes. If you enjoy our content, please remember to subscribe and review our podcast. I look forward to seeing you again on the next episode of the M&A Unplugged podcast. And until then, Please remember that scaling, acquiring, or selling a business takes time, preparation, and the proper knowledge.